Hi everyone, it's Jamie Fleming again, here with a follow-up to my original UPS financial analysis video. Today I'm going to address some of the questions that came up once people had a chance to watch the first video. If you haven't seen the first one yet, please go check it out, because if you don't, you'll have no idea what I'm talking about right now. For our first question, what about those record $5 billion profits I heard about? Are you saying that's not true? I'm not saying that at all. The reason I didn't talk about that is because I spent the entire presentation focusing on operating profits and margins, and also focusing on the U.S. domestic package division since that's where you guys work. The source of that bit about record $5 billion profits is here. 2017 net income for the entire company was $4.918 billion. But how much of that came from U.S. domestic package? In the last presentation, remember I said that UPS reports in 3 segments: UPS domestic package, international package, and supply chain and freight. Well, they only report revenues and operating profits by segment, so we're going to have to do some simple math to guess at how much of that net income we can attribute to U.S. domestic package. So here's the operating profit breakdown by segment. 59% of operating profit came from U.S. domestic package in 2017. So let's go ahead and apply that same ratio to net income, which gives us $2.9 billion of bottom line profit from the U.S. domestic package segment in 2017. It's a lot of money, but it ain't no $5 billion. But even more importantly, let's zoom out for a second here and think about this. Record profits is not that impressive really, because profits should be going up every year. That'd be like me bragging that I'm on track to make a record salary in 2018. Well, we get raises every year, so why would I be making less money this year than I did when I was younger? That wouldn't make sense. It's kind of a weird thing to brag about. So record profits, not that impressive. Record profit margins would impress me, but we already saw in the other presentation that they didn't manage that. Not even close. Profit margins are sinking. What about Trump's $1 billion tax cut? Once again, we have to figure out how much of that to attribute to the U.S. domestic package segment, so we're going to look at this same chart showing operating profits. 59% from U.S. domestic package means $590 million per year, or $2.95 billion over the 5 years of the proposed agreement. Well, as I told you in the last presentation, this proposed contract costs $4 billion more than the last contract, so we spent the tax cut. All of it. And then some. And that's assuming a new president does not repeal the tax cut, which anything is possible, right? In the last presentation, you heard me going on and on about profits and how FedEx is taking the lead in profitability. Well, what about revenues? Aren't UPS's still the highest? And it's your lucky day, because I finally have one good thing to say. Yes, UPS still has the highest revenues in the business. That top blue line is UPS revenues over the past 10 years. The green line on the bottom is FedEx ground revenues, which are still way lower than UPS. And then the purple line in the middle is the revenues from FedEx's entire U.S. domestic operation, ground and express together. Still hanging pretty far below UPS. Phew, right? Well, of course, you know I'm about to destroy this for you. Let's look at growth rates, because as I said before, growth is the only thing that keeps businesses alive. UPS grew 30.3% over that 10-year period, with a year-by-year average of 3.1% growth. FedEx domestic revenues rose 65.3% over that same period, with a year-by-year growth rate of 5.9%. That's nearly double. And FedEx ground revenues up 148.6% over 10 years, with average annual growth rate of 10.9%, which is more than 3 times the growth rate UPS experienced. And we're not done yet. I took ground out of this chart because their revenues are already included in the purple line. So let's take those trends and extend them out over another 10 years. If current trends continue, you could expect FedEx to surpass UPS in domestic revenues within the next decade and change. Now, if you don't realize how scary this is, let me help. The revenue and market share advantage is the only advantage UPS has. Their costs are, as we saw in the other presentation, dramatically higher. Their technology is way worse. If they lose enough market share to FedEx, you guys are, well, you're screwed. That's what you are. And for any of you who are under the age of 40 or 45 and hoping to retire from UPS someday, this is going to happen within your career. Well, now that everyone's all depressed, let's switch gears to something less terrifying. Let's talk about growth again. Growth is good. Many of you may have noticed that UPS is spending a ton of money to upgrade their operation. Could this be the cause of the falling profit margins I talked about in the last presentation? This is actually a really interesting question, but to answer it, I have to go full finance nerd for a minute. So the short answer is no, the money they are spending to upgrade their operation is not the cause of falling profit margins. The longer answer is, these investments are called capital expenditures, or CapEx, and they are not accounted for as expenses the same way labor costs or fuel costs would be. Instead, they're considered investments and show up as assets on the balance sheet. Basically, if UPS spends $100 million on a new facility, their assets go up by $100 million because now they own this shiny new building. And then that building is depreciated over the course of its useful life. So if they expect the $100 million building to be in service for 50 years, then that means it depreciates by roughly $2 million a year. Depreciation shows up on the income statement affecting operating profit, but much less than the full sum of the investment. So with our example, we would see operating profit fall by the $2 million of depreciation, rather than by the full $100 million they spent on the building. So there's part 1 of your financial accounting lesson for the day. Part 2 is this. What's the difference between operating profit and net income? My last presentation focused almost exclusively on operating profit and operating margins, because UPS and FedEx report those by segment, and that's what I was interested in. I also wanted to take the tax cut out of the equation when we talked about trends over time. But since net income came up in discussion of the $5 billion record profits, I want to quickly describe the difference to you. So as we learned in the last video, operating profit is just revenues minus all the operating expenses. Then there's a bunch of stuff on the income statement below that, and finally we reach the bottom line, net income. So what's all the stuff in between? Well, we have interest paid, interest earned, and investment income, which all together cost UPS $226 million in 2017. Then there's gains and losses on foreign currency exchange, which was $32 million in the green. Gains and losses on sales, asset write-downs, legal settlements, and other random bits and pieces come next, all of which cost UPS $27 million in 2017. And then finally the big dog, income tax, which cost them $2.243 billion last year. And that, my friends, is how you get to net income. In case you're curious, dividends to shareholders are paid out of net income, so they come after net income on the income statement. UPS does pay a dividend to shareholders, which is very common among large, stable, slow-growth companies. Those dividends are what keep investors coming back, despite the sluggish stock appreciation I showed you in the last presentation. And our final question is for you distrustful types. Where did the numbers you used come from? Well, good news for anyone who wants to check the accuracy of the work I did. All the numbers I use in the presentation are publicly available. The majority of the data came from UPS and FedEx's financial statements, which are filed quarterly and annually with the Securities and Exchange Commission, or SEC. I primarily focused on their income statement, which has information like revenues, expenses, operating profit, and so on. If you want to take a look at their filings, quarterly filings are called 10Q, and the annual filings are called 10K. You can find them on the SEC website at www.sec.gov and use the Edgar search tool to look them up. The link below takes you to Edgar. I will also be putting the spreadsheets with the raw financial data on the Teamsters Local 174 website if anyone wants to check my work and see for themselves that the charts I made are accurate. As for stock prices, those are also publicly available online. I prefer using Yahoo Finance, which allows you to download historical prices into an Excel spreadsheet, which is great for making charts. I hope this has helped clear up some questions, and as always, please continue to ask me any questions that you come up with, and I'll see if I can help answer them. Thanks again for listening.